Everything, of course, cannot be cut and dried, especially when it comes to revenue and accrual-based accounting. As you know, we look at how much can we really receive and how do we take that into account? How do we do those measures? Where do we recognize those adjustments? There's a lot of other things that can come into play, especially in the complicated world of business that we have now that we're not only dealing with the company down the street. Some of those issues that the 5-step process has is sales, returns, and allowances, repurchase agreements, things that are called bill and hold, principal-agent relationships, consignments, warranties, and non-refundable upfront fees. These are all different things that can come into play with the types of transactions that we have, especially when we're looking at large volume transactions or things that are ordered well in advance of a season. So let's look at these a little bit more in depth. Sales, returns, and allowances involve returning a product by a customer due to dissatisfaction in exchange for a refund, a credit, or another product in exchange. The seller recognizes an adjustment to revenue for the products to be returned, a refund liability, and an asset for the right to recover the product. The company that returns the product may receive full or partial refunds. They can get credits against the amounts that they owe or that they will owe, or they may just get another product straight across. Sales, returns, and allowances is something you have been exposed to conceptually, something that I'm sure that you understand from a consumer point of view. So let's look at this and how it's handled by a company. On January 12th, 2017, Vending Company sells 100 cameras for $100 each on account to Amaya Incorporated. Vending allows Amaya to return any unused cameras within 45 days of purchase. The cost of each product is $60. Vending estimates that 3 products will be returned. The costs of recovering the products will be immaterial, and the returned products are expected to be resold at a profit. On January 24th, Amaya returns 2 of the cameras because they were the wrong color. On January 31st, Vending prepares their financial statements and determines that it is likely that only 1 more camera will be returned. So Vending makes these entries related to these transactions. They record the sale of the cameras and the related cost of goods sold on January 12th, 2017. 100 cameras times $100 each. They have an accounts receivable of $10,000 and sales revenue of $10,000. The cameras cost them $60 each, so 60 times 100 is $6,000. So they recognize $6,000 in their cost of goods sold and a reduction in their inventory of $6,000. They received 2 cameras back on January 24th. So they will debit their sales, returns, and allowances, $200. They will credit accounts receivable, $200. This is the cost of the cameras for the customers. They will return to inventory $120 because they expect that these will be able to be sold for a profit. And they reduce the cost of goods sold by $120. Now, they expect 1 more camera is going to come back, but they're creating their financial statements, so they need to make allowances for that adjustment. They go to the sales, returns, and allowance account, $100. and then to an allowance for sales and returns of $100. These sound almost identical, but they are slightly different. So the sales, returns, and allowances account is a part of net sales, whereas the allowance for sales, returns, and allowances is on the balance sheet. They have an estimated inventory return of $60 and a reduction to their cost of goods sold for $60. So the income statement for the month is sales revenue less sales, returns, and allowances. This is going to include both their actually returned and their adjusted, assumed, estimated returned. Their cost of goods sold also is going to include both returned and the expected returned. To ascertain their gross profit, this is what is actually expected to occur. Even though there's going to be a slight blip in time before that third camera comes back. The balance sheet will reflect what they actually expect in the end, the net accounts receivable, because they have the allowance for sales, returns, and allowances. I feel a little bit like I'm stuttering when I say that. Offsetting their accounts receivable. And they have returned inventory included as an asset. Now let's assume that these cameras were sold for cash instead of on account. To record the camera's sale and cost of goods sold, we would have cash against sales revenue. The cost of goods sold is the same basic entry. And then, assuming that Vendon did not pay cash at the time of the return of the two cameras to Amaya, to record the return of the two cameras and related costs of goods sold, we have the sales, returns, and allowances against accounts payable. So this is from the customer side. We have I'm sorry, this is from the merchandiser side. My apologies. So what they've done is that they have entered a bill saying that they owe $200 to Vendon. You'll notice that the entries are in essence the same. The difference between cash and account is that rather than reducing our accounts receivable, if the customer paid cash, we're making an assumption that we're going to need to write them a check for those returns. Understanding that, then we would have an accounts payable on our books rather than a reduction to our accounts receivable. So let's move forward and look at our second issue, which is a repurchase agreement. So repurchase agreements are agreements in which the company has an obligation or a right to repurchase the asset at a later date. If the repurchase price is equal to or greater than the selling price, then the transaction is a financing transaction and not a sale. We're going to use Morgan Incorporated, an equipment dealer who sells equipment on January 1st, 2017 to Lane Company to illustrate this. This transaction and transfer or sale of the equipment is for $100,000. It agrees to repurchase this equipment on December 31st, 2018 for a price of $121,000. So we assume or impute an interest rate of 10%, and we make this entry. Remember, whenever there's not an interest rate stated, we will have an imputed interest rate, and we use the time value of money. And we recognize a financing transaction. We received cash of $100,000, and we owe to Lane $100,000. Then, on December 31st, we would have an accrual for interest. That would be an interest expense of $10,000, and then we would add to the liability to Lane $10,000. Now, on December 31st, 2018, when we repurchase, and I use the word repurchase in air quotes, the equipment back from Lane, we would have interest expense of $11,000, and then liability to Lane of $11,000. We would retire that liability of $121,000 with cash of $121,000. So in essence, when we have that obligation to repurchase it, we are going to bring it back to us. Although we have given them a piece of equipment and they have given us cash, this is not a sale. What we have basically done is we have handed over collateral for the amount of cash that we received. So for a bill and hold arrangement, this happens when a buyer isn't ready to actually take delivery. But they do take title and they accept billing. We recognize the revenue depending on when the buyer obtains actual control. This can happen when a buyer is, for example, setting up a brand new place, a brand new restaurant, and they're ordering a whole bunch of equipment, but they're not ready for it. And they've taken title, they have accepted billing, but they haven't accepted delivery or physical possession. They want you to deliver it in 6 months. They need to wait 6 months because they're building their restaurant. So let's look at Butler Company. And they sell $450,000 worth of fireplaces to a local coffee shop. This is because Barista is planning to expand its locations around the city. Oftentimes what can happen is that you can get a price break if you purchase in quantity. Under the agreement, Barista asks Butler to retain these fireplaces in their warehouse until the new coffee shops that will house these fireplaces are ready. Title passes to Barista at the time that the agreement is signed. So the question is, when should Butler recognize revenue from this bill and hold? Butler determines when it has satisfied its performance obligation to transfer a product by evaluating when Barista obtains control of the products. For Barista to obtain control of a product in a bill and hold arrangement, all of these conditions and criteria must be met. The reason for the bill and hold arrangement must be substantive. The product must be identified separately as belonging to Barista. The product must be ready for physical transfer. and Butler cannot have the ability to use the product or to direct it to another customer. If all of these are met, then revenue recognition would be permitted at the time that the contract is signed. So to give you kind of a visual imagining example, you have a warehouse, and in that warehouse you have an area that is partitioned off, and in it you have labeled all of these fireplaces, and they are all labeled as belonging to Bristow. And Butler will not pull a fireplace from there to ship to another customer. All of that occurs because it's identified separately, it's ready for physical transfer, it's obviously substantive. Then we can say that the criteria are met. So the entry to record this sale is accounts receivable $450,000. Or is $450,000 worth of fireplaces, and sales revenue of $450,000, and cost of goods sold of $280,000, and the reduction of their inventory of $280,000. Now, the important part to remember is that if, for example, Baristow's fireplaces are sitting in this isolated area of the warehouse, clearly marked for Bristow, and it comes upon time for inventory, those fireplaces do not belong to Butler. They cannot be counted into Butler's inventory. The third situation is the principal-agent relationship. The principal's performance obligation is to provide goods and services to a customer. The agent's performance obligation is to arrange for the principal to provide these goods or services to a customer. The principal recognizes revenue when the goods or services are sold to the customer, and the agent recognizes revenue in the amount of the commission that it receives. This happens all the time. Whenever you use Hotels.com, Priceline, something along those lines, they are receiving commissions. They're not actually the proprietors or the people who are providing the goods or services. The other one that can kind of throw a little wonkiness into you is consignments. So with consignments, these are a principal-agent relationship. The consignor is the principal and the consignee is the agent. The consignor recognizes revenue after receiving notification of a sale and cash remittance from the consignee. The consignee records the commission revenue after the sale is made. So let's look at an illustration here on how things occur with a consignment. This illustration is also in your text. Nelba Manufacturing ships merchandise costing $36,000 on consignment to Best Value stores. Nelba pays $3,750 of the freight costs, and Best Value pays $2,250 for local advertising costs that are reimbursable from Nelba. By the end of the period, Best Value has sold 2/3 of the consigned merchandise for $40,000 cash. Best Value notifies Nelba the sales, retains a 10% commission, and remits the cash due to Nelba. So upon shipment of the inventory from Nelba to Best Value, there is no entry for Best Value. The reason for this is because does not become legal title of Best Value. They are only keepers of Nelba's product. Nelba will typically have a very specialized inventory that is designated for consignment inventory and will move from their finished goods inventory to consignment inventory the amount of inventory that they are shipping. Nelba is also the individual who's paying the freight for getting the inventory from Nelba to Best Value. Best Value pays for and recognizes that there is, they actually don't show where they pay for the advertising expense itself. But they would bill Nelba for the advertising. They would receive, which is kind of what this transaction says here. They then would receive cash as they sell the merchandise, and as they sell it, this is the amount that would be payable to the consignor at that point in time. I can't remember what the company's name is now. Best Value. What Best Value is going to do is they have a total of $40,000 of product they've sold. The consignor owes $2,250 in the form of advertising expenses associated with this particular inventory, and then they have their 10% commission of $4,000. So they will only remit $33,750. Upon notification of expenses and commissions and sales, Nelba would recognize the offside. They're going to receive $33,750 in cash. They have $2,250 in advertising expenses, $4,000 in a commission expense, for a total of $40,000 worth of consignment sales. Best Value would have no adjustments for their cost of goods sold, whereas at that time, Nelba would reduce their inventory that is on consignment by the value of the inventory of the goods that have sold. Now, we have talked pretty substantially about contingent liabilities such as warranties. So we're just going to kind of brief over the top of this, since this actually does have substantial coverage in another chapter. But as you know, when a warranty exists, it needs to be determined whether it is an assurance type warranty or a service type warranty. Service type warranties are recorded as a separate performance obligation and are not included in the sales price of the product, whereas an assurance type warranty is included in the sales price. You should be relatively familiar with the warranty entries from a prior chapter, so we will just flip through these real quick. You are, of course, welcome to pause or go back and look at these as you see fit. Now, one other thing that can kind of be a little bit of a gray area is non-refundable upfront fees. These are generally related to the initiation, activation, or setup activities of the goods or services that are to be delivered in the future. The upfront fee should be allocated over the periods that are benefited. So, for example, when we purchase a membership fee in a health club, even though it is non-refundable, then what we would do is we would allocate it over the year or the 6 months or whatever that term is. There would be some defined term for us to allocate this across. We talked about some of the different things that can throw a monkey wrench into the idea of revenue recognition and how they impact net sales, or how they are handled, or what belongs to who when. We will close this particular section of the chapter now. And next we'll look at presentation and disclosures regarding revenue.